I agree. Since we're talking about companies and betting on tech companies, maybe that's a good case. Can we talk a bit about risk and volatility? Because I think there's a misunderstanding if you're not in the industry, or I can take Bitcoin is also a perfect example. Volatility isn't bad. You just need to know how to manage it. So if Uber, for instance, was a private company like it was for many, many years, that stock would be very volatile during the years. It would go up and down based on reputation risk, competitors, etc. But
Mm.
shareholders never see that volatility because it's not on the exchange market. So clearly there's a misunderstanding of risk and volatility. They can be paired and super dangerous, but they can also be misunderstood. How do you go about assessing risk in your portfolio and the investments you make?
Yeah, so volatility is dangerous if it means that you are forced out of your position at a bad time, which normally involves being leveraged. But if you don't have that issue, it is inherently an advantage that you have volatility as you indicate. So let me take two takes on it. The first one is that you're not playing to the advantage, but you have a very long time horizon. So you're investing, let's say as a private person, you start investing when you're 25 and you end investing when you're 80, 85 or something like that. You know, people get older and older. So you've got 60 years. And so what does it really matter whether your revenues go up in straight line or they do like this? I can't see that matters much because the important point is that it goes up, and typically the more volatility, the more on average it goes up. So you just ignore it. But there are lots of techniques to take advantage of volatility. There's something called dollar averaging and balance portfolios with rebalancing. For instance, if you have a portfolio of bonds and equities, and you say we just rebalance every quarter. So if you have a situation where the equities prices have dropped 30%, then you go in and sell some bonds. They would typically have gone up because when the equities have gone down, you sell some of the bonds, you buy more equities to rebalance. And if the equities then go up 200%, then you sell equities and buy some bonds. And on average, completely automatically, this will make you beat the market. And so, yeah, so you can implement a system that is a robot that automatically in the long run beats the market. Now, having said that, I'm not a fan of bonds, especially not of corporate government bonds right now because the yields are ridiculous. But that's another matter.